Have you tried everything and still found no real solution? If that's the case, the new minutes will be a game changer. Keep on watching.
Real estate with realtor Kashif Sohail. Welcome to Washington America Show with international multimedia journalist, multidimensional, multifaceted artist and director of Human Rights Justice Council USA, Dr. Kashif Sohail.
Home buyers should know about FHA mortgage insurance. Borrowers pay an upfront mortgage insurance premium at the time of purchase. For all loans made after January 26, 2015, the monthly premium depends on the base loan amount, length of the loan, in years, and the LTV. Monthly premiums range from 0.45% of the loan to 1.05%. Monthly premiums are larger for loans with a higher LTV, higher base amount of money, and longer length of time to repay. Eventually, monthly FHA mortgage insurance payments are no longer due. FHA mortgage insurance premiums terminate based on the length of the loan and the LTV. For mortgages with LTV ratios greater than 90%, annual premiums will be collected until the end of the loan term. For mortgages with LTV ratios less than or equal to 90%, annual premiums will be collected until the end of the loan term or 11 years, whichever happens first.
FHA only insures loans when the home, lender, and borrower meet specified criteria. FHA criteria covers items such as building structure, the method of construction, qualified appraisers, determining the creditworthiness of the borrower, and minimum standards for lenders. It also sets the maximum loan amounts that it will guarantee for various regions of the country.
There is no minimum income requirement to obtain an FHA mortgage loan, however, one must prove steady income for at least 2 years. Seasonal pay, child support, retirement pension payments, unemployment compensation, VA benefits, military pay, Social Security income, alimony, and rent paid by family all qualify as income sources. Part-time pay, overtime, and bonus pay also count as income as long as they are steady.
The FHA limits borrowers' debt-to-income ratio to 31% for housing costs and 43% for housing expenses and other long-term debt. Conventional loans commonly impose a debt-to-income ratio of 28% toward housing and 36% towards housing expenses and other debt.
In some cases, borrowers may qualify to exceed the FHA debt-to-income ratio if they meet certain compensation factors. This may include a demonstrated ability to pay more towards housing expenses, a large down payment, a demonstrated conservative attitude toward using credit and the ability to accumulate savings, acceptable credit history, compensation not reflected in the qualified income calculation, like food stamps or similar government assistance, a minimal increase in monthly housing expenses, substantial cash reserves, substantial net worth sufficient to pay the mortgage regardless of income, potential for increased earnings, as indicated by job training or education levels, and/or relocation of the primary wage earner.
FHA criteria are more forgiving than conventional lending criteria on the borrower's credit score, or lack of any credit history. Lenders must use FHA qualified appraisers to estimate the value and condition of real estate. Financed with FHA insurance. FHA appraisers must satisfy minimum professional criteria and follow FHA appraisal standards. While HUD does not regulate interest rates, it does set limits on the amount that it will insure.
Maximum loan amounts vary over time and by place, depending on the cost of living and other factors. Loan amounts are established from the average cost of homes in each marketplace, usually county by county. The FHA defines allowable closing costs that may be charged to the borrower. Each local FHA office determines reasonable and customary closing costs. All other costs in the transaction are considered non-allowable and generally paid by the seller when purchasing a new home or by the lender when refinancing your current FHA mortgage.
The Department of Veterans Affairs guarantees loans for eligible veterans that purchase, build, or refinance homes. These loans are part of the government mortgage assistance program. Under normal circumstances, the VA does not lend money. Instead, the VA guarantees loans made by VA-approved lenders. Unlike FHA programs, the VA can also lend money through its direct loan program. Only happens in extreme cases, where local mortgage money is not available to a qualified veteran.
The VA sets a limit on the amount of the loan that it will guarantee by issuing a certificate of eligibility to an eligible veteran. The certificate of eligibility does not guarantee that the veteran will qualify for a loan, but merely states his entitlement to participate in the VA program. A certificate of reasonable value, CRV, states the market value of the subject property based on a VA-approved appraisal and establishes the maximum amount the VA will finance. VA loans permit eligible veterans to mortgage property with little or no down payment and without purchasing mortgage insurance.
Primary market lenders qualify eligible veterans and real estate according to VA standards. Primary lenders then enter into mortgage agreements with qualified veterans. If the veteran defaults, the VA guarantees it will pay a portion of the mortgage and lender will pursue the veteran for the remaining balance.
The amount of the loan that the VA guarantees pays the lender if the veteran defaults is called the basic entitlement and is subject to change. The basic entitlement is a maximum amount adjusted locally based on the loan amount, currently, up to $36,000 for loans under $144,000, with a bonus entitlement of up to $68,250 for most loans over $250,000. The lender, not the VA, determines the maximum amount of money it will loan to the veteran and the interest rate.
The VA limits the amount of a loan it will guarantee, and will not guarantee any portion of loan that exceeds the reasonable value of the property as specified by a VA-certified appraiser in a certificate of reasonable value. While there is no maximum loan amount established by the VA, lenders will generally lend up to 4 times the amount of a veteran's entitlement without requiring a down payment.
The VA imposes standards to determine which persons qualify for VA-guaranteed loans. Borrowers must serve a minimum amount of time, 90 days in wartime, 181 days in peacetime, in the U.S. Armed Forces without a dishonorable discharge. The VA sets a limit on the amount of the loan that it will guarantee by issuing a certificate of eligibility to an eligible veteran, requires proof of military service. The certificate of eligibility informs the lender that the borrower is qualified to participate in the VA program, but it does not guarantee that a lender will actually loan the veteran any money.
Because the loan amount may not exceed the VA's estimate of the value of the property, the first step in securing a VA loan is an appraisal. A certificate of reasonable value, CRV, states the market value of the subject property based on a VA-approved appraisal and establishes the maximum amount the VA will finance for the appraised property.
The VA regulates a veteran's closing costs. Although some additional costs are unique to certain localities, authorized closing costs generally include VA appraisal, credit report, survey, title evidence, recording fees, a 1% loan origination fee, and discount points. The closing costs and origination charge cannot be included in the loan, except in VA refinancing loans. Under a VA guaranteed loan, there are no mortgage insurance premiums.
VA does not require a down payment if the purchase price or cost is no more than the reasonable value of the property, as determined by VA, but the lender may require one. If the purchase price or cost is more than the reasonable value, the difference must be paid in cash by the veteran.
The VA charges a first-time funding fee of 2.15% for most veterans, 2.40% for reservists. If the veteran has previously obtained a VA home loan, the funding fee increases to 3.30% for the loan and for subsequent use thereafter. This is payable at closing or may be financed with the purchase price. Fee may be reduced based on the amount of down payment. If the veteran makes a down payment of at least 5%, but less than 10% of the purchase price of the property, the funding fee is reduced to 1.50% of the loan amount, 1.75% for reservists.
If the veteran makes a down payment of at least 10%, the funding fee is reduced to 1.25% of the loan amount, 1.50% for reservists. VA guaranteed loans are assumable, even by non-veterans, and may be prepaid without penalty. Like FHA loans, interest rates are set by the lender, not the VA.
Thanks for watching, and don't forget to click the link below in order to find out more.
Please share this video, subscribe to our channel.
Are you looking to buy or sell a home anytime soon? If so, you've come to the right place. We'd like to give you the opportunity to work with one of the top local real estate agents and get the best deal when buying or selling a home. The fact is, experienced agents can often get you a 2 to 10% better deal on the purchase or sale of a property, mostly due to their experience in the local marketplace and their ability to negotiate the best deal. So contact our top agent now and start the process of buying or selling your home.